Hi, I'm Nita Asher, and this is PwC's Tax Insights in Brief. On July 4th, President Trump signed the act, formerly referred to as the One Big Beautiful Bill Act, into law. The act permanently extends various international tax provisions enacted as part of the 2017 reconciliation bill known as the TCJA that were set to change at the end of this year. This legislation comes at the same time as the announcement of a G7 agreement, which in principle may limit the application and impact of the OECD's Pillar 2 global minimum tax to U.S. multinational companies. Some of the highlights of the international changes include modifications to the GILTI regime, which is now named Net CFC Tested Income, or NCTI. The Act decreases the Section 250 deduction for NCTI for tax years beginning after December 31st, 2025 to 40%. It also eliminates the deemed 10% return on certain tangible business assets, QBI, from the calculation of both NCTI and FDII. Sticking with FDII, which the Act renamed Foreign-Derived Intangible Income, or FDII, the Section 250 deduction for FDII for tax years beginning after December 31st, 2025 is reduced to 33.34%. It also makes other changes to the calculation of deduction-eligible income, known as DEI, which is a necessary component in calculating FDII. For example, DEI will no longer include income from certain sales or deemed sales, deemed dispositions, or transactions subject to Section 367D of certain intangible property and property of a type that is subject to depreciation, amortization, or depletion by the seller. The Act also modifies the expense allocation rules for purposes of calculating DEI by excluding interest expense and R&E expense, potentially increasing the amount of a taxpayer's income qualifying for the Section 250 deduction. Further, it makes changes to the base erosion and anti-abuse tax by slightly raising the BEAT rate to 10.5% for taxable years beginning after December 31st, 2025. It also retains and makes permanent the favorable treatment for the R&D credit and a portion of applicable Section 38 credits for purposes of calculating the base erosion minimum tax amount. Finally, the Act also made changes to foreign tax credits. It modifies the GILTI/NCTI deemed paid credit from 80% to 90% of foreign income taxes, as well as make significant changes to the expense allocation and income sourcing rules. Importantly, interest, R&E, and other expenses that are not directly allocable to NCTI are ignored for purposes of the foreign tax credit limitation, moving NCTI towards a more traditional type of alternative minimum tax. Notably, the final legislation did not include either the House-passed or Senate Finance Committee proposed Section 899 to address countries with so-called unfair foreign taxes. The provision was removed upon agreement with the other G7 countries to exclude U.S. parented groups from both the undertaxed profits rule and income inclusion rule in respect of both their domestic and foreign profits. But importantly, the agreement does not turn off qualified domestic minimum top-up tax, or QDMTT. Republicans have stated that they reserve the right to reintroduce Section 899 if the other parties walk away from the G7 deal or slow walk its implementation. Taxpayers should model these and other international changes included in the Act to see how it affects their cash tax position, compliance procedures, and operational footprint. For more details, read the attached insight. Thanks for watching. This has been PwC's Tax Insights in Brief.